Good morning. Welcome to Asia Society Hong Kong Center for our our program this morning, where we're featuring a well-known member, a longtime member of Asia Society, Dr. Weijian Shan, who will be talking about his new book, Money Games, the inside story of how American dealmakers saved Korea's most iconic bank. So we're really delighted to have Shan with us again here at Asia Society Hong Kong for our online programming. And we're delighted today that we will have Pete Sweeney, Asia Economic Editor for Reuters Breakviews in Hong Kong, to do to help us moderate today's this morning's discussion. Before I get started, hand it over to Pete. Brief introduction. Dr. Shan is, as I mentioned, longtime member, no stranger to Asia Society here in Hong Kong. He's chairman and CEO of PAG, Hong Kong-based private equity firms with 40 billion in capital under management. And he has been a longtime resident of Hong Kong here, and he studied at Beijing University of International Business and Economics, where he also taught as a faculty member, and he was affiliated with University of California, Berkeley, where he received his PhD. And we're delighted that he is with us to talk about his new book. And also in the past, we have hosted a program with Out of Gobi, My Story of China in America. And we are delighted that Shan will be doing a program with us on November 9th, 7 o'clock, 7 to 8:15 p.m. to talk about Out of Gobi. The program will be in Mandarin. It will be the Mandarin edition of Out of Gobi. So we're really honored to host Shan for another program there. Pete is somebody who has been based in Hong Kong now, but has been a long time, previously served as Reuters chief correspondent for China economy and markets, running team in Shanghai and Beijing. Before, he was editor of China Economic Review, a monthly magazine focusing on news analysis on mainland's economy. He's a Fulbright scholar and has conducted research in Chinese aviation industry and outbound M&A. So we're really delighted to have Pete moderate this program this morning. So I'm going to hand it over to Pete Sweeney to get this morning's program started. Thank you.
Okay, thanks for the introduction, Alice. And it's a pleasure for me to be here. I'm a member of the Asia Society. I got it as a birthday present last year, and I have not been able to attend any of the events physically. It's unfortunate that this one is going to have to be remote, but I'm really glad to be and honored to be once again talking with Shan Weijian. Really impressive guy and a good speaker, always a fun conversation. And I'm really excited to talk to you about your book today. Shan, I'm just going to start off with the question that I think I first asked when we were chatting about it earlier, which is just like, this is, as a journalist, you're generally looking for comments, stories of things that happened like yesterday or 2 days ago. And you've decided to write a book about a transaction that kicked off during the Asia financial crisis back in 97, 98. Can you just explain to us why you chose to write this book now and why you think it's relevant and worth reading for people today?
Thank you. Well, first of all, thank you, Alice and Pete, for having me on this program. Really honored to be here. To your question, I remember many years ago when Richard Nixon first visited China. We heard a story that some reporters interviewed Premier Zhou Enlai, asking him what he thought of the French Revolution. And his reply was, "It's too early to tell." So, French Revolution happened a long time ago, 1793, and its relevance is still felt today. And to me, the book is not just about the old story. It's very relevant today because private equity is a major industry. Today, it is perhaps the largest financial sector in a country like the United States. What do I mean? Private equity firms control more companies than all the publicly listed companies combined. That is how powerful private equity is. And private equity, of course, moves a lot of money around, and they do iconic transactions involving iconic names, brand names. So it's very much talked about, but very little understood. I'm sure many people have read the book, The Barbarians at Gate, which was published in 1989. It was a book about a private equity transaction, KKR's acquisition of RJR Nabisco. It was $25 billion, the largest ever at that time. But the book was written only about a year after the transaction, dealing only with the deal-making part of the transaction. I think very few people know, even though the book is a bestseller and made into HBO movie, very few people know that KKR stayed in that investment for 15 years. He invested $3 billion, borrowed $22 billion. At the end of 15 years, they lost about $750 million. So as far as the investment is concerned, it was not a very successful investment. But few people know about it. It was never written about it. It was certainly never written about it by the insiders. So my book is a story, an inside story of a major private equity transaction that covers from very beginning, negotiation, deal making, investment, turning around of the institution which we invested, and then all the way to the exit of that investment. So it's a complete story of a private equity transaction like no other book has ever done. And that's why I think it's very relevant to today. The story took place at a time of great economic stress as we're facing today, and has consequences which are relevant to the economic conditions that we have today as well.
What I really enjoyed about the book, I mean, was how thorough it was. For one sense, it was in part like a narrative of an extremely frustrating, trying kind of negotiating process that seemed to go back and forth endlessly, and then give kind of a textbook explanation of what the logic was, of like why you held the line here, why this was a compromise, and why you couldn't give ground on this particular aspect of the deal when you're dealing with the Korean government, which is trying to get the best deal for itself, a politically sensitive moment, over a giant bank that had basically nationalized, right?
Yes.
Can you talk to us a little bit about like dealing with the Korean government, and kind of what the lessons were that you took away, from wading into what ended up being an extremely challenging transaction full of political pushback. You had your struggles with some of the regulators. You just talk about that first phase of the deal of getting it over the line, and kind of what you felt led to your success in that particular phase.
Yes, the negotiation process was very difficult, and at times negotiations almost broke down. But I must say that I have gained the highest respect for our counterparties, the Korean government officials, through this process. They were trying to do the best for their country, for the taxpayers. So they were making a great effort. But we'll have to remember the background against which the story took place. This was back in 1998 and 1999. It was in the depths of Asian financial crisis of that time. Just to put it in perspective, on October 23rd, 1997, when the Asian financial crisis first broke out, Hang Seng Index here in Hong Kong dropped on that day 16%, 16 percentage points. Now, it's very rare for such collapse of the market to happen on one single day. By the end of that year, currencies across Asia collapsed from Korea all the way to Indonesia. The only country spared was China because the country was under capital control. But look at Korea. By December, Korean stock market dropped 49%, almost half of its value. Its currency, won against the US dollars, dropped 65.9%, two-thirds of its value. Its foreign exchange reserves came down to $8.9 billion. Now, again, to put this into perspective, Korea was and remains, South Korea, the 10th largest economy in the world. For its foreign exchange reserves to drop to less than $9 billion, that was just astounding. My firm, PAG, manages $40 billion. So the entire foreign exchange reserves of the country of Korea dropped to a level that it could last only about a week before it ran out of money, before it had to default on its foreign obligations. So it was at that time when IMF and the World Bank came in and provided a rescue package to Korea to a tune of $58 billion, largest ever by that time, just to save the Korean government from a sovereign default. The situation was so dire that the Korean government encouraged citizens to sell their jewelries, their gold, in order to help replenish the foreign exchange reserves. So that was the background, how bad the economy was at that time, even worse than the pandemic-induced recession today. Now, the rescue package that IMF and the World Bank provided came with a condition. And the condition was for Korea to sell two failed and nationalized banks. At that time, about 150 banks in Korea failed, and the entire banking system basically was on the verge of a collapse. So IMF thought that the reason commercial banks failed in Korea was because there was a lack of risk management system. Lending was based on relationships and government policies, and that's why they had so many bad loans, representing by that time about 30% of the total assets. So they thought in order to restructure the banking sector in Korea, somebody would have to bring in some credit culture and risk management systems. If that expertise could not be found in the country, then foreign investors are needed. And that was the reason for the condition for the Korean government to invite foreign investors to come in to buy one of the two banks as a condition for the $58 billion rescue package provided by IMF. It was against that background we went into Korea to negotiate with the Korean government. So Korea was in very tough time. The government, for the first time, was setting control of a nationwide bank in Korea. This never happened before. South Korea developed its economy mostly on foreign borrowed money. Their belief was that equity upside should be kept in the country, so they could only borrow money from foreigners as opposed to bring in foreign direct investment. And that was a double-edged sword. When times were good, of course, foreign money really helped. But when there was a capital flight, as in 1997-98, the country got into trouble. But the government officials tried their best to do the best deal for the Korean taxpayers, the public, and for the government itself. So it's fully understandable that the negotiation would be difficult. But in spite of that, we underestimated, as I describe in the book, how difficult it became. You're on mute, Pete. Pete,
it was interesting to me that like in the course of the negotiation, you discovered that there was this crisis brewing at Daewoo, a big chaebol, and that had been part of the problem on the regulatory side. That this big creditor or borrower from KFB that you've been dealing with, was in a lot more trouble. But then what was interesting is also after you closed the deal, your new team came in and promptly got into a bit of a mess with Hynix. So you seem to consistently struggle to change the credit culture. Is that a theme that you've seen repeated with other deals? Underestimating how difficult it is to change, relationships or the culture within a company in terms of risk control?
That is right. In private equity, when we do a major buyout, major turnaround, sometimes you just can't get it right the first time around. But as private equity investors, our way of doing things is that we need to bring in the best management team from anywhere in the world, a world-class management team. But very often, a CEO works out in one situation, but not necessarily in another situation. Cultures are different, institutions are different, industries are different. So sometimes we make mistakes. And when there's a mistake, you will have to correct the mistake immediately. And that's what we did. And
it was just interesting that you brought in...
We're trying to build a culture, credit culture, which could not be changed overnight. So it took a multi-year effort to do so.
Yeah, I mean, you brought in a new CEO. Your first CEO didn't made the wrong call on some credit decisions and overexposed you to Hynix. But your next guy was French and didn't speak Korean at all and spoke heavily accented English and yet managed to turn things around, which I thought was quite impressive. But how reproducible is that model of, I mean, these days when you think about like multinationals investing or PE coming into China, say, or Japan, there's a lot of localization of we need local talent, we need local people, we need local expertise. And yet you seem to do a lot with completely, a very foreign leadership team, at least at the top. Is that something you've done with other deals mostly, or how do you balance, when you bring in the French guy with the no Korean versus the local person who's connected?
I will be giving out something that I'm still working on. That is another transaction involving a Chinese bank.
Yes.
We took control of a Chinese bank a few years after this particular story in Korea. And the CEO we put in place was Frank Newman, who used to be chairman CEO of Bankers Trust. And prior to that, he was the deputy treasury secretary of the United States. He spoke no Chinese, but he knew banking inside out. Very often you couldn't find the perfect combination in the CEO. In the case of this Korean bank, again, I don't want to give out too much. I hope the audience will read the book. He was a French guy. He, of course, didn't speak Korean. He doesn't speak Korean today either. And his English is heavily accented with a French accent. But he knew banking inside out. And he's very sensitive to different cultures as he worked in different cultures around the world. So in spite of his language limitation, he was able to communicate very effectively with the staff and eventually did a great job turning around that bank.
One institution that doesn't come off so well in your book, I mean, it's interesting first that Newbridge Capital, which is a private equity firm, was invited to the bidding, and you kind of pointed that out. That ordinarily, if you were going to have somebody take over a struggling Korean bank, you would want another bank to do it, not necessarily. But you had experience, through David Bonderman, TPG, who had flipped an American bank, and I think during the savings and loan crisis and turned it around. That's correct.
Yes.
Yeah. So so you had a bit of experience, but you went up against HSBC, in the market, and then you on the tail end of the transaction, you tried to sell it to HSBC, and both times that bank did not seem to come off very well. And you drew some conclusions about bureaucracy and how kind of rigid or slow they had been. I'm just wondering if you want to comment specifically about HSBC or more generally about the ability of large institutions to be nimble enough to execute this kind of deal. Have you seen improvements on that front, or?
HSBC is a great institution, global institution. Just to provide some background to the audience, when the Korean government decided to sell the banks to foreign investors, it engaged Morgan Stanley to invite foreign financial institutions to come in to bid for these banks. And Morgan Stanley sent out 40 invitations, mostly to large banks and other financial institutions. The government had a strong preference for a bank to buy one of their failed banks as opposed to a private equity firm. But only two institutions showed up. One was HSBC, and the other was Newbridge Capital, which was affiliated with TPG, the San Francisco-based private equity firm. That is my firm. So we were competing with HSBC. So I described how we competed with them, basically behind the scene, because we didn't know what they were doing. They didn't know what we were doing. We were simply guessing what they were doing. And I think in comparison with a large financial institution with many layers of bureaucracy, of course, we were, as a private equity firm, much more nimble, and we were able to make decisions very quickly, or much more quickly than a large bank. And towards the end, it's not that we tried to sell the bank, this bank that we bought. We didn't try to sell bank to HSBC. They tried to buy it from us. It was the second time they attempted to buy a bank in Korea. And it was a very interesting competition between two banks, one of which was HSBC. So in my story, I talked about how they competed with each other to try to buy this bank. And it was a very interesting story. I think that HSBC is a wonderful financial institution with a lot of international best practices embedded into it. But like all large institutions, sometimes decision-making is slow. So it is suitable in certain circumstances, under certain circumstances, but not under others. And we're the same. Very often we will not be able to compete with a large bank like HSBC.
If I can ask you to put on your economist academic hat for a second and just talk about systemic risk. So if you're looking at what happened in Korea then during the crisis and the weakness of the banking system, these relationships, lending, and the bad debts kind of came crashing down. This is something we've seen a bit of in Japan, and also obviously in China. There's been this big campaign to reduce financial risk in the banking system. We've seen a couple of banking collapses. What similarities do you think there are now between the risks you were looking at then in the banking system compared to now in Asia, and specifically, I guess, in China?
Why specifically with regard to China? Because
I'm interested. You can comment on Asia. But like that's the place where we've seen headlines about small banks, folding under. Being taken over, nationalized by the government. So it's what people are anxious about, I think. But certainly Japan has its own issues, I think, and possibly South Korea as well these days.
Yeah. I can talk about how a financial crisis can be actually good for a society in the long run. As we know, 97, 98, Asian financial crisis was very harsh on all Asian economies. In Korea, banks failed. In Japan, banks failed. Indonesia, of course, the country went into a severe recession, and almost all Asian countries were affected. So many banks failed. But 10 years later, in 2008 and 2009, the so-called global financial crisis occurred with the collapse of Lehman Brothers, Bear Stearns, a number of banks in the United States and in Europe, RBS and so forth, and AIG, the insurance company. And in 2008 and 2009, if you remember, almost no Asian banks failed. Almost none of them. I can't think of any one failed during that crisis, even though global banks got into severe trouble, especially in the United States and Europe. Why was that the case? It was because during the financial crisis in Asia in 97, 98, all the Asian countries restructured their banking system, like in Korea, like in Japan, like in Indonesia, recapitalized them, increased the reserve ratios, introduced the risk management system, so that 10 years later, Asian banks became very resilient. The Chinese banking reform began in 2002. Actually, 2 years prior to that, by the end of 1999, Zhu Rongji already ordered the 4 largest state-owned banks to carve out all their bad loans into so-called AMCs, asset management companies, financed by the Ministry of Finance, and then instructed them or made them to bring in foreign investors. All of them brought in foreign investors, eventually went public. And they did the same restructuring as in Korea, in Japan, Indonesia, and in some other countries. So 10 years later, during the global financial crisis, all the Asian banks, including Chinese banks, the major ones, were very resilient, very healthy. So none of them got into trouble. Now, fast forward to today, we are in an unprecedented economic crisis since after the war. And some people suggest it's in some ways worse than the Great Depression. I'm not sure of that, but certainly since after the war, we have never seen such great economic recession, of course, induced by the lockdown connected with the pandemic. But today, how are the banks faring in the United States, in Europe, where the economy contracted so much? Banks are doing fine. In fact, they are making record earnings in the United States. In Europe, they are also very healthy. And why is that the case? That is because they learned a big lesson in 2008 and 2009, and regulators tightened the regulation so much that the capital within these banks as a percentage of assets practically doubled, and reserve ratio is increased. The loan standard is much tightened. So when this crisis came, it didn't really severely affect the banks. So they have learned a good lesson from 2008 and 2009. Imagine if the pandemic happened in 2008 and 2009, how bad the situation we would have been, right? All the banks would fail, the economy would fail, and now banks are supporting the economy. And at that time, banks were dragging down the economy. So each crisis brings some lessons to the regulators, to the financial institutions. And if you restructure the banking system and make them healthier than before, then it will help you tide over the next crisis, which inevitably will come. I mean, that's the law of economic cycles. Every economy, sooner or later, get into trouble, and the banking system has to support the economy when the trouble comes.
Well, so it's interesting to me, especially the Chinese banking system, which has just gone through this campaign to reduce systemic risk, whatever you want to phrase it. I'm curious how you would rate progress on the project to clean up the balance sheets and bring like off-balance credit onto the books. And also, if you could talk a little bit about the bank valuations, because they seem to be very unpopular with equity investors these days. Some of them trade at deep discounts to their book value. So like the Chinese banking system and the Japanese banking system also look very, very cheap on that metric at least. Can you talk a little bit about the current state of Chinese banks?
Yes. If you look at the state of affairs of Chinese banks before, say, 2002, before these banks restructured themselves, turned themselves into joint stock companies, brought in foreign investors like Bank of America, Goldman Sachs, and the like, eventually brought them public on Hong Kong Stock Exchange with ADRs listed on New York Stock Exchange and so forth. Before that time, I still remember around 2001, Moody's issued a report about the bad loan ratio in Chinese banks after they audited one of the major banks for the first time. At the request of the regulators, they reported the bad loan ratio was more than 40%. If it's more than 40%, the bank is insolvent. They stay afloat because implicitly, of course, there's the government, central government, sovereign support. Right? That was how bad the situation was. And the reason that the Chinese banks accumulated so many bad loans was because banking was done very similar to in Korea. That is, relationship banking, policy-induced banking, without much regard to credit worthiness of the borrowers. And the problem is that the frontline workers, let's say a branch manager, will be able to make loans to a customer just making the decision by himself. That system, you can imagine, would create corruption. I know you, so I can make a decision to give you $10 million. You need it to operate your business. And if I don't say yes, you wouldn't be able to get it. So that creates corruption. And that system was, of course, the source of the problem of bad loans. But what happened after 2002, when these banks went public, they brought in foreign investors, set up risk management systems, they changed the way they make loans. Frontline workers would not be able to make credit decisions. The credit committee, which doesn't come into contact with customers, make the decision. So the frontline branch manager can only bring in a customer applying for a loan. Then the credit people will have to decide whether or not to extend the loan. So with that reform, of course, the banking system is much improved after carving out the bad loans, after recapitalizing them with especially foreign capital, especially after their IPO, they became much more healthy than they ever were in the past. Now, today, I would say by and large, Chinese banks are very well capitalized. Banks are traded below book value. Around the beginning of 2000, banks were traded at about 2 times book value after the Asian financial crisis. In China, around 2008 and 2009, banks were traded at about 4 times book value. Today, it's a fraction of book value. And it's not just Chinese banks. American banks, Korean banks are traded at below 50% of book value. And why is that the case? I think the good time to buy banks, to invest in banks, are over. The reason is, and this is good for banks, for society, but not necessarily good for investors. The reason is after the Asian financial crisis and after especially 2008, 2009 global financial crisis, banking regulation is so tightened and capital requirement is so enhanced. And now capital as a percentage of asset is twice as much as about 10 years ago. So if you want to generate, let's say, 15% return on equity 10 years ago, if you were generating 15% ROE, today you will have to use twice as much capital to generate the same amount of earnings, and therefore your ROE would drop to 7.5%. And that's why the return is much lower. On top of that, of course, there's reserve requirements, there's compliance requirements, and there are all kinds of costs associated with managing the banks. So now it is too costly to operate a bank. So 10 years ago, if you buy a bank at 1 times book value, it was a steal. It was a very good deal. Today, if you pay 1 times to buy a bank, you may not be able to make 10% ROE.
Right.
That's why the has come down so much.
Let me segue. Thank you. That's a good answer. Let me segue into certain comments by somebody you may have heard of. Jack Ma recently gave a speech at the Bund Forum where he was quoted railing against regulators for holding back innovation, especially in the tech fin or fintech space. He was critical of the Basel Accords, which is part of building up these capital buffers that I think you refer to, and then just seemed generally fairly negative about it. And now, obviously, the anti-IPO has been suspended. There are some new regulations out that look to be re-regulating the way that fintech companies work. So first, I wanted to get your reaction to what Jack Ma said and what's happened with the anti-IPO. And second, if you want to talk about your investment, I mean, you're in Lexin FinTech. You've got your own investments in that space and how you see that playing out for PAG's strategy.
I think that the suspension of Ant Financial's IPO probably has nothing to do with the remarks that he made. People are critical of regulators and regulation all the time. We do it all the time. And the fact is that regulation improves over time. It's never perfect. And only by pointing out their shortcomings can you hope to improve regulation over time. If you look at the United States, the regulatory environment in the United States, it tightens, it loosens, it tightens, and loosens over time, depending on economic conditions. So I think it's perfectly all right to be critical of regulators and to help them kind of improve the ways that they do things. I think the suspension of Ant Financial probably has a lot to do with the fact that the regulators are considering measures to tighten regulation of non-bank financial institutions. In the past 3 years, extending back to 5 years, China has been tightening regulation regarding shadow banking. As you know, the shadow banking sector, including trust companies, small loan companies, peer-to-peer lending, consumer finance companies, have been so tightened that many of them went out of business. Now, shadow banking is a shadow of its former self. It used to be a very large sector, but now it's a very small sector. It is necessary to deleverage the economy because otherwise it became too risky, and that's what happened before 97 Asian financial crisis, what happened before 2008 and 2009 global financial crisis. So I think regulators were prudent to tighten the regulation, increase the capital requirements for all these financial institutions. Now, Ant is so big, they are talking about raising $37 billion, largest ever in world history for an IPO. And that would value the company at more than $300 billion, larger, I was told, than JP Morgan, the largest global bank in the world, and HSBC, probably the second largest combined. With that size, you can think if there's a risk, the risk will be systemic. But a financial institution like that is not a bank. It's not regulated as a bank. There's no capital requirements. And you would wonder whether or not that is too risky. You would find that in 1997 and 2008, many non-bank financial institutions went into trouble because they didn't have capital and their funding source came from banks. And when their customers became very risky, then they create systemic risks. So I think it's prudent if the regulators are thinking of regulations about capital requirements to halt the IPO until this material information becomes available. And I think it's just prudent thing to do. And from the point of view of the Chinese regulators, you can imagine that the success of Ant's IPO would be very good for China. It enhances.
Well, I guess, I hear that. I'm just wondering, because obviously people are quite upset. A lot of investment bankers have spent a lot of time on this, and the timing seems suboptimal coming so late in the process.
I agree. Yeah.
But do you basically agree with the assessment that like Ant, because you've got some skin in the fintech game, as it were, with Lexin, I think. We had a bunch of Chinese fintech companies listed in New York, and they like P2P lenders, stuff like that, I believe. They've been pretty beat up by the stock market because of these late breaking regulatory changes. How should foreign investors process this? Not just that like the idea that the risk is there, which I think everybody is aware of, but that the regulators would make these decisions, in this sort of sudden manner, because I don't think anybody expected this IPO to get derailed with all this money in escrow.
Yeah, you can look at the market from the point of view of investors, and you can also look at the market from the point of view of the society or from regulators' point of view. From the point of view of investors, you should always be prepared for changes in the regulatory environment. For example, at one time in my life, we were going after the largest consumer finance company in Japan called Takifuji. We were going to buy control of that consumer finance company. We were not successful in our effort. 3 years or 2 years after our effort failed, that company failed because Japan changed its regulation on the interest rate ceiling for consumer finance companies, bringing it down from 29% to about 15%, and making consumer finance companies responsible for all the excess interest they collected in the past 10 years, which drove almost all non-bank related consumer finance companies into the ground. So today, the only consumer finance companies in existence are affiliated with banks in Japan. So as an investor, you have to be very careful about regulatory environment changes. And sometimes regulators overdo it, sometimes they underdo it. You can be critical of them, but you as an investor will have to consider the risks. Now, when it comes to fintech, there are two types. If, that's a very broad concept. Some finance companies take risks by making loans, from their customers, and some don't. The company we invested in, for example, does not take any credit risks. They simply process the credit for banks, and they themselves don't take risks. And some companies provide software for banks in order to improve their underwriting and their risk management. So there are different types. And if you take credit risks, then you really have to worry about the market changes, because I think the Chinese regulators are being prudent to try to raise the capital requirements for non-financial institutions, to clamp down on shadow banking, and to put some discipline into this sector. In the long run, I think it's good for the market.
I'm just interesting how you see the balance, because the government is saying two things, and perhaps you can reconcile them for me. On the one hand, they want to de-risk the system. On the other hand, given the unprecedented stress that the system is under, particularly private sector, and particularly the smaller ends of it, there's a push for banks to get more lending to small and medium enterprises, to prop them up. Now, of course, that's a very risky thing for a bank loan officer to do, to lend to companies that have no sovereign guarantee, no backing, that are smaller and have less collateral. And in the past, what the shadow banking system did, for better or worse, was at least partially it served those people, right? At charging much higher rates that reflected, the higher risk that you would get. But is there a risk that on balance, do you think the government has the mix right, or have they gone too far? Because depending on who I read and the numbers I look at, it's like all this credit is just going to state-owned enterprises, and they're, it's just going to the same old industrial Goliaths, and it's not being delivered to the private sector, to the innovators or whatever that you need. And then others will say, well, basically it's kind of trickling down and things are okay. What's your take?
Well, there is a dilemma. The dilemma is that in the old days, when the state-owned sector dominated the economy, today it's only 25% of the GDP. Once upon a time, it was 75% of GDP. At that time, the government could tell the banks to do whatever the government wanted them to do, right? To lend to this and not lend to that. And that was more of a command economy structure, which China moved away from since about 40 years ago. Today, the private sector is very large, and the government knows that it is the driver of the Chinese economic growth. So it knows the banks consider the private companies to be too risky and therefore are reluctant to lend to them. So they said even a quarter, half of your new loans, the government, said a quarter, half of your new loans will have to be lent to the private sector. But then they also hold bank officers responsible for the bad loans that they make. So how do you reconcile these two things, right? So bank officers are held responsible for bad loans that they make for life. That is, even after you retire, you're held responsible. So no matter what quota you impose upon them, they will have to evaluate the risk of the borrower. And private sector, as you point out, is more risky. And therefore, in spite of the efforts, I think the credit provided to the private sector is still much less than necessary from the point of view of policy makers. And of course, the shadow banking system came into the scene because of that. They would provide high rate loans, high interest rate loans, sometimes 30% or even higher to the private sector. And of course, the high interest rate offsets the risks that they take. But where does the money come from? Now, if the money comes from banks, then it's equivalent to banks taking the risks, and especially if the consumer finance companies are not well capitalized, so they have enough capital to be the first buffer. Now, in the shadow banking system, 3 years ago, actually the money came from retail investors, because this shadow banking companies, let's say trust companies, sold so-called wealth management products, 10% interest, 12% interest to retail investors. So when a loan goes bad, retail investors will not be able to recover their deposits. And worse is that they sell these products, since their distribution capability is rather limited, they sell this product through banks. And banks think, well, this is just third-party products. We take no responsibility. We have big distribution. We'll just sell them and call them wealth management products. But the truth of the matter is the Chinese consumers are not that discerning. And if it's a product sold by a bank, they think it's very safe. And then they get into trouble, right? When the trust companies which issue these products couldn't pay them back. So I think it's all these problems that prompted the regulators eventually to say, well, it's too risky. The societal loan ratio is too high, and there's too much credit in the marketplace, and it's too risky, and retail investors are being hurt, and therefore we'll have to tighten the regulation. So there's a history behind the tightening of the regulation, which is still going on. I think in general, it's good for the Chinese economy. Now, if you look at today, the Chinese financial system, we know we're in a zero interest environment. In the United States, the QE, the Fed buying of bonds, and the fiscal stimulus drove interest rate practically to zero. Now, if you deposit US dollars in the bank here in Hong Kong, you receive almost no interest at all. But in China, look at US treasuries. 10-year treasury, I would say now is about 50 basis points interest rate. But in China, it's still 3 or 4%. So money is much tighter in China than elsewhere in the world. So I think the regulators are just being very prudent.
I'm sorry, I've been rude to our Q&A session people who have been submitting some questions, and I haven't passed them on to you. So at this point, I'm going to pass on some from the audience. The first is just your reaction to the U.S. election and how that might impact acquisition market in Korea, China, and elsewhere. And then
just a second, U.S. election?
Yeah, well, just what's your take on how the I think basically your take on the U.S. election results as it stands at this point?
I think we'll have to wait for at least another 24 hours to comment on that because we don't know the result as yet.
Well, I think one thing we do know is that there was not a landslide, and it's pretty clear that whatever we end up with, it was a very tight race, which indicates that the United States, is very, very much divided on kind of the way it's going forward. You've worked in the States for a long time. You've been around for the last 4 or 5 years.
It has been divided in the past 4 years. So
sorry?
It has been divided in the past 4 years, but I think it makes a big difference who becomes the next president. And for that, we'll have to wait until the dust settles, and it has not settled. So I'm not going to make any comment in that regard.
All right, fair enough. One other question, which I know you have an opinion on, your view of how the national security law is influencing the investment environment in Hong Kong?
Well, what I care about is whether or not Hong Kong remains a free society anchored by the rule of law. And that is a necessary condition for Hong Kong to be an IFC, International Financial Center. And my view is Hong Kong remains a free society anchored in the rule of law with independent judicial system. And there was a background with regard to the national security law, and that was the unrest in the second half of last year, which drove the Hong Kong economy into a recession, as we know, even before the COVID hit. I think that the national security law brought back social stability, as we all see. I think the implementation of the law will be carried out through the independent judicial system, which is deeply rooted in the common law tradition, and therefore I'm not so worried about the law being abused. And I think that Hong Kong will remain a free society with the rule of law.
Okay, well, as somebody who likes living in Hong Kong, I do hope you're right. I'm going to pause at this point. I think we're going to move to the private Q&A session. So for just thanks for giving us your frank thoughts, Shan. Just interesting as always. Alice, do you want to take back the microphone?
Thank you very much, Pete.
Thanks, Shan.
Thank you. Thank you both for this wonderful discussion. And as Sun said, election, the dust has not settled. But for me, this has been a great discussion in terms of kind of, I don't want to say distraction, but I think kind of focus on a topic that is still very, very important here in this part of the world, about lessons learned from, I think what I take away from it is really lessons learned from the last financial crisis and how it is really helping us through the current crisis. So until the dust settled, there are still some great programs here at Asia Society. We're really delighted collaborating with International Literary Festival. And I mentioned the program that Shan will be doing with us on November 9th, talking about his book in Mandarin, Out of Gobi. So please join us for those of you who are Mandarin speakers and who are interested in, but I think we will keep an eye on the election results and also reactions. I think Pete's last question, one of the questions from the audience about the election. I heard from my colleague yesterday in New York that on Monday, this coming Monday, Asia Society in New York will be hosting a really fantastic program talking exactly about that with impact of the elections. And so by then, we hope we will have an idea of who the winner is of the presidential election. So tune in at all the Asia Society program. We have been so, I'm personally very grateful to the Asia Society Network during this during this COVID crisis. We have brought some really relevant and also important topic and speakers like today. So please, be part of the Asia Society Hong Kong family or the Asia Society Global family, and we look forward to more programs like this. And thank you again. My gratitude to Dr. Shan and Pete Sweeney. So we will now stay tuned for the what I call the private reception. And for those of you who are interested in taking part in these type of private discussion, you can be part of that by becoming a President's Circle member or our corporate members. So stay, for those of you who are going to stay on, and for those of you who are going to be I will be bidding farewell to you and look forward to welcoming you back. Thank you.